Alex, thank you so much for being able to join us today. As you know, I wanted to talk to you a little bit about the way that we do financial regulation here in the United Kingdom, and it really is all in support of the programme that we have together, University of Warwick and Bank of England, the Global Central Banking Qualification, as we call it, or the Masters in Central Banking and Financial Regulation, as it's marketed around the world. But I'm really grateful for you for making the time. You served on the FPC for 2 terms now, I think, isn't that right? Yeah. So there's a lot that I think a lot of people would be very interested in hearing your views about financial regulation, how it works here in the UK, what you think our particular strengths are, and where we perhaps could learn from other countries. So I think that's where, if it's okay with you, that's where I'd like to start. So let me start with the first of those then. So you've seen the FPC, how it works from the inside, our way of doing financial regulation. What are some of the real strengths that you've observed about our system?
Thanks. I mean, that's a great question and goes to the heart of it. And I think probably the main point is we're actually quite lucky in the UK that we have a well-developed framework for the way we do financial regulation. And looking back on my 6 years in the FPC, I think actually one of the most important things that we've had was given to us by the UK Parliament, and it was a very clear mandate. Coming out of the crisis in 2008, that mandate was to promote financial stability, and it was given to a group of independent people. And that's a very important thing to have as a financial stability authority, because there are always pressures not to act. But actually, when you're given a clear mandate in law to promote financial stability, concentrates the mind. And we've also been very lucky that the mandate's clear enough to say to us, not just to pursue financial stability, but to say, when's enough enough? When the FPC was set up, people said, well, won't it pursue the stability of the graveyard? And actually, the remit's very clear. It says pursue financial stability, but not beyond a point where you are reducing the long-run growth of the economy. And that's important, not just because it tells us not to impose our own kind of preferences on things. It's a very clear kind of way to balance considerations. But it also reminds us of why we care about financial stability. It isn't an end in itself. It's a contributor to the long-run growth and prosperity of our economy. So we're very lucky to have that mandate and that clear framework. But we're also blessed with very wide-ranging and flexible powers. And the UK adopted an approach after the financial crisis of not trying to write a very long rule book. It didn't say to the FPC, right, you will operate this tool, and this tool, and these are the ways you will operate it. And I think that's very sensible, because the financial system's always evolving, always changing. The risks are always that it faces are always changing. Many of the risks that I've dealt with over my 6 years on the FPC, no one imagined even 6 years ago. So the fact that the FPC was given not some tools, although it does have some of those, but just a power to make recommendations to anybody, and a very powerful ability to make so-called comply or explain recommendations to the regulators, means that it can be much more flexible, much more responsive to the changing world around it. And I think the great thing about it is that it keeps the FPC focused on the outcome, which is financial stability, rather than the inputs, this tool, that tool, or the other tool. It's basically a mandate to do whatever it takes, or say whatever needs to be said to pursue financial stability. And I think that framework, that mandate and those powers have meant we've been very lucky in the UK.
So, I mean, that's very interesting. Just to delve into that a little bit more, how does the FPC, and I think successfully, how does it manage the twin pressures, perhaps to even do too much from public and maybe politicians? So, for example, the COVID struck and the Bank of England moved very quickly in terms of dividend disbursements and stopping them to make sure that banks had a healthy balance sheet, whilst at the same time keeping in mind exactly what you said, sort of the long-term growth of the economy, and we'll come back to it, but there might be issues now brewing in terms of sort of inflation in the short term, but then the requirement to sort of try and claw back some of the lost growth because of the pandemic. So there's always these forces, perhaps they manifest at different times, the short run versus the long run. But how do you deal with those pressures, perhaps to do too much, given that they're you have all these powers?
Yeah, I think the FPC has been very disciplined because it's got this legal mandate. There's no escaping the fact that it has to balance these considerations. And so every decision you're involved with on the FPC effectively isn't just, it has two parts. So the first part is, what do you need to do? What direction do you need to go in to promote financial stability on whatever the issue is? But then there's a very important second part, which is how far do you go in that direction? And my experience is that on every issue we faced, the first part has been almost the easiest part. The second one is the most difficult one. And that requires really impressive, and I was very lucky to see it, really impressive staff work to give you the analysis about the trade-offs, about what's the optimal amount of stability you want to build in, what are the costs of going further, what are the costs of not going far enough. And the FPC then has to make a judgment. But this is where a committee of people is merely the tip of the iceberg. They're the ones making the ultimate decisions, but they're nothing without this huge iceberg underwater of very impressive staff work to support those often finely balanced decisions. But I think here the committee structure works well as well, because you've got a range of views, a range of expertise around the table, and people contribute it pretty freely because everyone in this area isn't following a fixed playbook. There isn't the sort of literature to follow that there is in monetary policy. There aren't, no one's got a Taylor rule for financial stability policy. And so you are making new judgments. You're writing the playbook for financial stability as you go. And that's why it's really important to have a group of people with different perspectives, diverse backgrounds, diverse opinions, so that you can form a better informed consensus about how far to go on any particular measure. Not too far, but also far enough. And that for me was the most interesting, but also the most difficult part of the FPC's job. But I think this is where the mandate's important, because without being clear about that, the FPC would be perhaps unwittingly, implicitly imposing its own preferences. And as an unelected authority, I think its legitimacy comes from pursuing a clear mandate from the elected body, Parliament and government, rather than having the ability to sort of stamp its own preferences and judgments on things. And that, I think, is great for the long run legitimacy of what we have in the UK.
Yeah. Okay. No, that I understand. So in the interest of balance then, you're a very experienced central banker. So you're aware that other countries do things a little bit differently. And sometimes presumably there are things that we could learn from elsewhere. So what sort of other sort of practices would you point to and think, actually there are some advantages there or some things which we could perhaps import a bit more?
Yeah, I think we've always wanted to import as much as possible. And it goes to this point that the playbook for financial stability policy isn't written. There's no set of instructions to follow. So nobody has a monopoly of wisdom on this thing. And I think we've tried to always look up and out from our own problems and issues to, well, what can we learn from others in this area? I think, as I say, we've been pretty lucky and blessed to have what I think is a world-leading framework for doing this in, and I thank the UK Parliament for doing that. I think where we've tried to learn most from others is in the practical operation of policy. So we have always, when we've thought about a measure, the first question is always, has anyone else done anything like this? So we looked, for example, at what Ireland and Sweden had done around their housing markets and mortgage markets before we put different but similar measures in place here. And we talked a lot to them and said, what do you wish you had done differently? You went first. Thank you. We looked very closely at what Spain had done around dynamic provisioning for bank losses as a way of informing what we wanted to do with bank capital buffers. We looked at what the Euro area and the US did around limits on very risky corporate lending, so-called leveraged lending. Now, we didn't follow any of those to the letter, but they were all really, and there are many more, but they were all really important examples of areas where we looked to others to learn. And in this endeavor, I think financial stability authorities really have to look to everyone else to learn, because everyone's doing something new. and we can all learn from each other. There's no point making the same mistakes twice, or everyone having the same regrets. And we've always tried to look up and out, and I think that's served us pretty well, and I hope we continue to do that.
How about the issue of sort of international competition, which has come to the fore a bit with the UK having, we've left the European Union, and so we're charting something of our own course. And is there a tension in being caught somewhere between the United States and the European Union? Does the FPC need to worry about that, or is it something that we can be more focused on just sort of domestic stability?
Right. Well, two parts to the answer to that, I think. It's a big question. I think, number one, we can't just focus on domestic stability. That's important. But I think it's vital that the UK in particular focuses on its role as a custodian of a global financial centre. Because, as you used the two examples, between Europe and the US, the UK is an absolutely crucial linchpin in the global financial system. And we, as regulators here, have a vital role in overseeing that. So we are custodians of something that is a global public good. So the FPC spends as much of its time on issues around the UK as a safe global financial centre as it does around domestic issues. But the second, I think, most important point is that there isn't really a trade-off between maintaining the UK as a global financial centre and financial stability. In fact, the two things tend to go together. To be, in the long run, a successful global financial centre, you have to have a stable financial system. And that's for two reasons, really. One is no one wants to do business in somewhere that doesn't have a kite mark of safety. So it's really important that we have high standards of prudential supervision, of financial stability, so that people want to do, it's a safe place to do business. But the other reason, I think, is that we have a financial system, because we're a global financial centre, that's 10 times the size of our economy. You can't have that unless it's safe. And you only need to look at 2008, when a global financial system centred here effectively sideswiped the economy and the taxpayer bailed it out, to realise that it's unsustainable to do that in the long run unless it's safe. So actually, the FPC has this important job, but it's not a difficult trade-off. Building a safe financial system is actually an essential foundation for having a competitive and durable global financial centre here, and it's a very important role as a custodian of that centre.
So I can understand that. So that then, one other aspect that presumably helps give people confidence, as you said, safety is going to be really important, but predictability is also important, so that people sort of know what the rules are and they feel comfortable they know what the rules are. Isn't a side effect, or how do you deal with it? Isn't a side effect of having the FPC having such wide powers that they can, as you said, essentially rewrite the playbook? How does the UK manage that and make it say, yes, but we're not rewriting the playbook just for a laugh. We are, we're rewriting the playbook carefully, in a considered manner, in a predictable way. How do you marry the requirements of predictability with the good news about the flexibility?
Yeah, this is a really important question. And I don't think historically enough weight has been placed on this in financial stability policy. You compare it to, say, the huge literature about time consistency in monetary policy. We've always been careful to try and apply as much of that thinking to financial stability policy as possible. And that's for two reasons. One is it's beneficial for the financial system to know how we, the FPC, might respond to various events, so that there are no surprises. But I think the second thing, and this is what you learn from the monetary policy literature, is you can have a lot more effect if your actions are anticipated. So if people know how we're going to react, we don't need to do as much often. So we've been trying over time, not just to write the playbook, but to share it with people so that they can understand our, to use the technical term, reaction function to things. And the area where this was, I think, particularly acute to start with was around stress testing and bank capital. After the financial crisis, stress testing was all in vogue. Stress banks, test them. And actually we thought, sure, but how do banks know how severe a stress test we're going to show up with next year? And when they don't know how severe a stress test we're going to show up with, what does that mean? Does it mean they will be reacting in a way of constraining lending because they're worried we might get out the wrong side of bed and just whack them with a really severe stress test? Actually, it's not great for time consistency, not great for the legitimacy of public policy either. So we tried to introduce a regime that was more predictable. And that didn't mean it was unchanging, but it meant that people could begin to anticipate how banks could say, well, I know the world has changed this year. This risk has gone up. So I anticipate this bit of the stress test getting tougher. But this has happened, so I anticipate it getting lighter. And there might still be some surprises, but they sort of knew the framework we were operating in. And they could then anticipate that. And interestingly, what we found was that as risks emerged, banks would begin to respond to them because they would do the math, so to speak, and think, okay, the Bank of England is going to show up now with a more severe China stress or a more severe leverage lending stress because we see what's going on. So we're going to anticipate that. We're going to change our behavior now, or we're going to hold more capital against it so that we make sure we pass the stress test. I think that made us more predictable and therefore more legitimate, but also in a way more powerful. It meant that our policies got more traction without us having to do a lot. And I think it's really important as financial stability policy develops that mentality is applied more broadly so that the financial system isn't, if you like, living in fear of which side of bed the regulator is going to get out. And actually it just knows and is able to anticipate things. And this is where monetary policy has a lot to teach financial stability policy after the last 30 or so years, but hopefully financial stability policy can get there faster.
So capturing the time inconsistency sort of problem, I think is really important, and I see how the FPC is dealing with that. A different tension that I know people have pointed to, and I know that the FPC has thought about oftentimes before, and that is the relationship between financial policy and monetary policy. And I'd be interested to know, I mean, this is a tension everywhere. The Bank of England is not unique, but it will have its own ways of managing it. So perhaps you can take us, I mean, to make that real, maybe it will, in the not too distant future, you can imagine a situation where quantitative easing needs to go in reverse. The Bank of England decides that it wants to do less of it, but that has implications for the balance sheets of the banks. It might also coincide with inflationary forces. None of us have a crystal ball, but it is possible that the decisions around QE and inflation are working against each other. I mean, how can that tension be managed?
Well, this is a really difficult issue. And it's one that people have been grappling with now for years. I think, though, from our point of view, it's actually quite simple in that monetary policy should pursue its objective, price stability, and then financial stability policy should deal with any consequences of that. That's the ideal way of working it, because having two instruments or two sets of instruments, a set of monetary policy instruments and a set of financial stability instruments, should mean you're able to get better outcomes. Without financial stability tools, you face the kind of monetary policy would face the kind of invidious choice it faced in the mid-2000s of, do we pursue short-run growth and price stability at the risk of building up imbalances that later cause bigger problems? Having two sets of tools means monetary policy can focus on its mandate, knowing that financial stability policy sort of has the rest covered. Simple, you think. And that generally is the way things operate and should operate, actually. And there have been many ways in which the FPC has responded to the fact that the economy has demanded very low short-term interest rates and very low long-term interest rates, actually, to hit the inflation target. To name a couple, I mean, firstly, we've had to deal with the inevitable consequence of a very low interest rate environment, which is pockets of risk-taking. There are people in the financial system who have absolute return targets, and so in a very low interest rate environment, they take more risk. They want more leverage. They run more liquidity risk. And so the FPC has to be alert to those things, and in many areas, we've taken action to deal with them. But the other area is you need to make sure financial regulation doesn't cut across what monetary policy is trying to do. And a good example here is the leverage ratio that banks are subject to, which limits the amount of leverage banks can take. Now, if the central bank expands its balance sheet through QE, with the old leverage ratio, that would mean banks' balance sheets got bigger, and hence the leverage ratio got a tighter constraint on them. So you'd get this perverse result of loosening monetary policy but tightening credit conditions at the same time. Wrong answer. So actually the FPC had to respond to that by saying, okay, we need to take central bank reserves out of the leverage ratio, which solved this problem. So that's a way that financial stability policy can support what monetary policy wants to do, as well as dealing with the consequences. And that's, I think, really, some people say, well, isn't that monetary policy and financial stability policy in conflict in some way? I actually think the fact that sometimes they might be moving in different ways shows that they are complements, and you're achieving a better outcome than you would if you just lumped it all on monetary policy and said, you go deal with everything. Because then they'd face this invidious trade-off, really, between meeting their mandate and storing up trouble for later. Now, there may come a point in a very low interest rate environment where it gets too much. The risk-taking takes off. Financial stability policy can't keep up. It lacks the measures. We haven't reached that point, but you can imagine it. Now, the UK framework, again, has sort of thought about this. And at that point, the FPC would need to say to the Monetary Policy Committee, actually, risks are building now that we don't think we have the ability to deal with anymore. Back over to you. And then the MPC's remit actually gives it the ability to trade off some short-run stability for greater long-term stability, if it needs to. Now, ideally, you wouldn't do that. The FPC would play its role, but that's a sort of last resort option. And again, it goes to the framework having thought through these things. But this all makes coordination between the two authorities important, but actually not as difficult as many people, I think, at first imagine.
Is there an argument for, is the tempo right? Because I believe both the MPC and the FPC meet once a month if things are going
well. MPC meets, I think, every 6 weeks, and the FPC has a quarterly cycle. So you've got sort of two MPC rounds for every one FPC round.
Now, if and when the interest rates start to change, the economy responds a lot on expectations. So when the direction of interest rates start to change, even if the actual magnitude is really quite modest, you might find a lot of assets changing their prices, and therefore a lot of the perhaps hidden risks of people being overly levered coming out very, very quickly. So because expectations can change really, really rapidly, when the MPC starts to change direction, is that not a time perhaps when the FPC would need to be ready to act more rapidly and more fleet of foot, or is that also sort of catered for?
Well, actually, I think you need to anticipate that. So if you find yourself in the position of reacting to events like that, then actually to use the monetary policy language, you're behind the curve as a financial stability authority. Actually, the better way, and this goes to a general sort of philosophy of financial stability policy, which is not to ask what could happen in the short run. It's to ask, well, what could happen over the next few years? And not to try and forecast. Don't fall into the trap of forecasting. And to say, well, look, could X happen? If so, let's get the system ready for it. And I don't know where interest rates are going to go over the next year, over the next month. But I know that at some point they could go up. And so it's very important that financial stability policy, and this is what it's done, knowing that, make sure the system is resilient to changing asset prices, changing yield curves. And it doesn't, if you like, assess the resilience of the financial system based on current interest rates. It says, well, look, would it be all right if interest rates went up so much? And this is why stress testing is actually at the core of what financial stability policy does. Because effectively you're saying, what set of bad events could happen? Who knows whether they will, but just could they? And let's just throw them at the banking system in particular, but the wider financial system as well, and ask, could it deal with it? If not, do something about it. So hopefully, by the time you get to the point you've described, you're not sort of scrabbling around saying, how do we make sure the system's resilient? You're saying, okay, we thought about this. We knew it could happen. System's got resilience to it. Some people will lose some money. Asset prices will fall. Some people will maybe make some money. That's what a financial system's all about. But it's going to be resilient to it. But this general philosophy of don't look to forecast when you're doing financial stability policy. Just ask, could something happen, and then prepare for it, I think is really crucial to not just these sorts of events, but also the general approach to financial stability policy. It makes for, in some ways a miserable existence because you're constantly worrying about what could go wrong. And it destroys your hair color in the process. But, it's actually what's needed. And you look back to the lessons of the financial crisis of 2008, it was really the issue that nobody had thought, what could go wrong here? They asked the question, is it okay? Or is there a housing bubble? They didn't ask, might there be a housing bubble in the US? Or might the system be over-levered? And that's really the question you want to ask in financial stability policy rather than a sort of forecasting question.
Do you think that the global financial system is more fragmented and domestic than it was in the past? I mean, after the global financial crisis, a lot of national regulators had to, they dealt with their domestic banks first, understandably. But to some extent, we're moving into a world where it feels that resilience at home is being prized. We have a ring fence here. The Europeans and the Americans have different approaches, but all of them have considered very carefully their own domestic financial system. Do you think that it is more domestic than it was, and is that a problem anyway?
I don't know whether it's more domestic than it was. Certainly there is more, you use the word ring fencing, of domestic activities. And, in the UK, we've separated or ring fenced domestic banking activities from other activities. I think that's a sensible first step to protect your sort of domestic markets. But you also want to make sure the other bit is resilient too. This isn't a case of a sort of ring-fenced castle of stability for the domestic stuff, and then the rest can just go hang. Because in many ways, finance is more international than it was 10, 20 years ago. The UK is still the major global financial centre. And that means that we can't have financial stability in our own economy just through the ring-fenced bit being stable. You need a stable global system as well. And I think this is where it gets difficult for organizations like the FPC, because no institution on its own, no domestic institution on its own can solve lots of these problems. When you look back at March 2020, when the COVID shock really hit, we saw problems in the gilt market. The US saw problems in the US Treasury market, problems in other sovereign bond markets as well. That's not financial stability. And monetary policy authorities had to take drastic action to stop financial conditions tightening for their economies. Now, this wasn't a domestic problem in any one place. It was a problem domestically, but it wasn't caused domestically. Yeah. The cause here was lots of non-bank financial institutions in response to the shock, effectively scrabbling for cash and selling assets of all sorts, including sovereign bonds, to get cash. And that then translates into a domestic problem. And lots of these institutions not even located here, they're located globally. Yeah. So actually, you need, for true financial stability, to have not just a stable sort of domestic system, but a stable global system as well. And that's why the FPC has always tried to engage heavily with international organizations like the Financial Stability Board, the G20, because lots of these problems can't be solved domestically. They require a kind of coordinated global solution, global agreement, so that we can solve a problem we all have, but none of us can solve individually. And I think that's something that we had after the financial crisis, and we have to work really hard to keep that kind of global commitment to financial stability, recognizing that none of us can ring fence our financial systems or economies from others completely.
My next question is sort of lobbying, or to put it more politely, the financial institutions who operate in the UK do have a legitimate point of view that that they I guess, should be allowed to make to the FPC as to things that would work, things that wouldn't work? Have the trade-offs that you're considering, are they accurate, at least as far as they pertain to the financial institutions? How, if at all, is the industry voice heard? And if it is heard, how do you stop it drowning out everyone else's view?
Yeah. Okay. Well, I go back to the most important thing being the clear mandate the FPC has. Yeah. So it can be open to as wide a range of views and perspectives as possible. Nothing changes the fact that the law says pursue financial stability, but not beyond a point where you compromise the growth of the economy. And, every FPC member wakes up in the morning, that's on their mind, that's the law. Yeah. And no matter what anyone says to you, that's what you have to do. So that's the core of it. But I think engaging with the financial system, with the industry, different parts of the industry, I think is absolutely vital so that you can make those finely balanced judgments about quite how far to go. Because often the industry will give you insights that no amount of data or other analysis will necessarily give you. Now, you have to take that sometimes with a pinch of salt, since what you would otherwise do isn't necessarily in their interest. That's why you have financial stability policy, because the externalities in the system mean that private institutions won't take socially optimal decisions. And once you know that, your job is to annoy them, because that's why you exist. You can listen to what they say and often learn a lot from it. I talked earlier about reforms to the leverage ratio to exclude central bank reserves. We talked to bank treasurers to learn more about the impact this was having so that we could calibrate the thing. Yeah. We didn't say to them, what should we do? We wanted to find out specific things from them, and they can give that intelligence to us. So the FPC's tried, I think, to engage with in as wide a variety of individuals and institutions around the industry. The other thing that's really important is that it doesn't just engage with, if you like, incumbent institutions. Yeah. The system has changed a lot in 5-6 years, changed massively in a longer period. Yeah. So if you just engage with institutions who are sort of big and dominant today, you risk missing what's important for the future. And one of the really important things the FPC has to do is to make sure regulation keeps up with the way the financial system is changing. This is if you like, the flip side of the good part of the regime, which is you're focused on an outcome. It is that you have this really difficult job of saying, no matter what happens, you have to respond to it and keep the system safe. So the FPC engages not just with, the familiar names, the big banks, investment funds, but also with new players, new payments providers, new forms of wealth management, new banks. Not because when they show up, you just need to whack them with regulation. Yeah. Far from it. But you need to understand how these things are developing so that you can understand how the financial system is reshaping and constantly ask the question, is the regulatory framework we've got sufficient to deliver the outcome we want? And if not, we've got to change it. You can't rest on, well, this is the framework. Yeah. That's I think the great feature of the regime, but it means you're constantly having to engage with as wide variety of institutions as possible.
So that brings me to the next thing I think I'd like to discuss, which is the financial system, as you yourself have just pointed out, isn't just big banks or entities with a banking license. You might also think of huge insurance companies and perhaps fintechs. So how does financial regulation take them into account? Are there different rules for different segments, or is it more that you take a sort of a market approach and look at the gilt market as you're describing, or at sort of pensions and whether they're working for the UK consumer?
Yeah. That's a good question. And actually, you've got to I think the key is to stay focused on what it is you actually care about. And from the perspective of the economy, what you care about in financial stability is people being able to get credit when they need it, people being able to make payments when they need to, and people being able to insure risks when they need to. And what you saw in 2008-9 was that effectively all of those services were threatened, and that's what sideswipes the economy. So looked at like that, you're focused on not necessarily the packaging of an institution, but what does it do? What service is it providing? And that cuts both ways, I think. So one way is some people who don't call themselves banks are basically doing banking. And this was a problem with shadow banks back in 05, 06, 07. And looked at from the perspective of the FPC now, you don't want to look at the label on the bottle. You want to look at the wine that's in it. And if it smells like a bank, regulate it like a bank, regardless of the label. And then the other way to think about this is, well, new players might come in who have a particular packaging. They're not a bank, but actually they're doing something that's really quite important to the economy. For example, what's been going on in payments recently, we now have lots more players involved in payments rather than, the really old school way was your bank just transferred it from one ledger entry to another ledger entry. Now you've got, when you scan your mobile phone at the coffee shop, there are a number of important links in the chain, many of them not banks, tech companies. Yeah. And it's really important because you take the perspective of it's the payment that matters, that those people are subject to appropriate regulation. And likewise, you talked about markets in your question. They're what's important for the economy as well. It isn't the participants in those markets that matter for stability per se. Yeah. It's the functioning of those markets when people need it. Now, if, as happened last year actually, the behavior of the participants in those markets, to use a technical term, screws up the functioning of those markets, then that's a problem and needs to be addressed and is now beginning to be addressed. But you're always, I think, looking to what is it that matters for the economy? What is it that needs to be stable in the system? And don't worry about what it's called or what wrapper it has. Yeah. And then regulation needs to be aligned to what it actually is and why it matters rather than what it's called. So it isn't one size fits all regulation. It has to be quite tailored, but it's always with an eye on what is this thing doing that actually matters rather than what's it called.
Let's explore that a little bit further and perhaps think about the sort of short run versus the very long run. And as a vehicle for this question, I think climate change is probably a good one to look at. So the Bank of England has been very forthright in noting that climate change can represent a significant risk to the safety and soundness of the financial system. Assets get rapidly changed. Insurance companies find that they need to make payouts, for example, a lot more. What is an appropriate role for the FPC, if at all, in climate change? Or is this something more for the broader central bank, or maybe it's for policymakers? Or how does the climate change issue fit within the mandate that the FPC has?
Yeah, good question. And this has grown obviously rapidly over a number of years now, and it's risen up the FPC's agenda as it's risen up everybody else's agenda. It's an issue for a wide number of groups, certainly for governments, certainly for central banks, but also specifically for financial stability authorities. And I think the FPC's prime role in this is to ensure that the financial system can deal with the transition of our economy that governments have now committed us to. So UK government has said net zero 2050 or sooner. It's got intermediate targets by 2030 as well. So although we don't know the specific measures the government will take to actually deliver that commitment means we know there will be a big structural shift in our economy. So the first job, I think, for the FPC is to make sure that the financial system can deal with that transition. It isn't an obstacle to it, if you like. And the way we're doing that is by subjecting the system to some exploratory scenarios that say, all right, this is how the structure of the economy will shift as we go to net zero. If you don't change your current book of assets, what will be the effect on you be? Now, it's not a stress test because obviously banks won't keep their current book of assets, but it's to concentrate the mind and give banks a measure of, over the next 10, 20 years, how much of a shift in their book do they need to undertake, and insurance companies actually, in order to maintain their risk level as the economy undergoes this big structural transition. And that's, I think, the first thing. But that has a really important side effect, not to be underestimated, which is in doing these sorts of exercises, you're encouraging financial institutions to measure the true risk of their exposures. So something that looks on a backward look very safe, digging coal out of the ground, actually is existentially risky now. given this commitment to net zero. Whereas investments that in the past that looked entirely speculative actually now are very safe bets. And that's why it's really important that risk assessment in banks, insurance companies, and other financial institutions actually takes that into account. Don't just look at a backward-looking VAR metric to assess the risk in something. Take account of this very important nugget of information you've been given, which is the economy is going to net zero by 2050 or sooner. Now, if you can get that taken into account in risk management decisions, things will be priced to reflect those true risks. And that means capital will be allocated more efficiently in the economy and in a way that's supportive of the transition to net zero. Whereas if those risks aren't being taken into account, capital's mispriced, things are still being allocated to or loans and other capital still being allocated to industries that are going to shrink or need to adapt, and not enough capital is being allocated to areas that need to grow or really adapt. And so I think the FPC's job has this sort of prime objective of stability, but it's going to have this really, really important add-on effect of making sure that risks are properly priced in the financial system, and therefore make the financial system a supporter of this very important transition to net zero, rather than a sort of obstacle to it.
I think so. Just to explore that, or a question I think that raises for me, and I think that a lot of people find quite interesting, is that sounds eminently sensible and really quite wise, to think about the transition of the economy that the government's committed to, and to making sure that the financial system doesn't stand in the way. But it also suggests that the people responsible for financial stability, the FPC committee, to what extent do they need to work with the body that's responsible for microprudential regulation, the Prudential Regulatory Authority in the UK context? Because some of this you could take your snapshots at the FPC committee every so often and say, yes, we seem to be on track, or we're not on track, and we're going to try and do something else. But the system would presumably be a bit smoother if it worked in tandem with the sort of day-to-day regulation of these institutions, sort of saying, we have the government has committed us to this particular target. We don't want to do this in jerks. We need to be thinking about how to smoothly adapt the loan book, for example, of our institution. So how does so the question, I guess, is what are the good parts about the way that the FPC works with the body responsible for regulation, which in the UK context, as you know, is the Prudential Regulatory Authority? This
is really important, and actually the cooperation here needs to be and is even closer than it is with monetary policy, the issue we discussed earlier. And it's helped by the fact that the chair of the FPC, the governor, is also the chair of the Prudential Regulation Committee. It's helped by the fact that the chief executive of the Prudential Regulation Authority is also a member of the FPC. So they're kind of natural inbuilt coordination mechanisms. And the way I think to think about it is very much as you described, that the Prudential Regulation Authority is responsible for the day-to-day supervision of banks and insurance companies in this respect. The Financial Conduct Authority is responsible for many other institutions. The chief executive of that is also on the FPC, but let's put that to one side for a second. That the regulator is responsible for the day-to-day. The FPC doesn't roll up its sleeves and second guess all that and try and meddle in it. The FPC's job is to say, you microprudential regulator, you're doing your job. How can I help you? How can I help you? One, look at the macro picture, the macro risks, so that when you're looking at your bank, you've got a bigger, wider field of vision about the risks it might face. Two, how can we help you assess some of the risks out there that maybe if you just look at your bank in isolation, you won't see? So your bank's doing a lot of leverage lending to risky corporates. So are 5 other banks. And actually, those corporates have become quite highly indebted. So you need to know that that's a risk. So you can help microprudential supervision that way. But you can also, as the FPC, impose the sort of framework that microprudential supervision operates in. So take bank capital. It's the FPC's job to say what's enough and what's too much, and then communicate that to the microprudential supervisor, because the FPC is the one with the mandate to build stability but not to compromise long-term growth. And the other way, in terms of climate change, in which the two work together, is that the FPC will, if you like, set the overall framework, which in this case is make sure the system is resilient to the transition, look at the scenarios we're going to use to assess that resilience, implement the exercises. But it's for the regulator to look bank by bank at the consequences of that and what action it wants to take at a bank by bank level. And I actually think that has worked pretty well in the UK, where the FPC hasn't meddled in sort of individual decisions. That is the expertise of the supervisor. But the supervisor has been able to use the FPC to give it, if you like, this wider field of vision to do a better job than it would be able to do if it was just sort of narrowly looking at its own institutions.
So on that, and again, we touched on it earlier, would forward guidance have a role to play as far as the FPC is concerned? I mean, as you pointed out, the government has made commitments about net zero, for example. You could imagine the governor standing up and saying, well, financial regulation to adapt to that mandate from the government is going to be taking these sorts of steps in financial regulation, changes in capital adequacy ratios or leverage ratios, or how green assets versus brown assets might be treated, and so on. Is there a role for that sort of forward guidance, or is it more problematic?
Very possibly. And it goes to this point we discussed about time consistency. I think it would be helpful at some point for the financial system, for the regulatory authorities to lay out their assessment of, if you like, the true risks in things. And capital requirements will need to reflect those true risks. In fact, if banks have their own internal models that are capturing the true underlying risks of exposures, then they will begin to capture this as well, because given the government's commitments, the carbon price, now I use that term as a sort of catch-all for regulatory measures to limit carbon emissions, the carbon price is going to rise. It's going to rise a lot. And you want your risk models as a bank to capture that. And so you want to be looking at a corporate's plan for adapting to a very sharply rising carbon price over the next decade or two. And that means some forward guidance is probably needed. I don't think we're at that point yet. We're still at the stage of making sure people have the capability to assess the risks. And I think that's actually the most important step. Once they have the capability to assess the risks, a plan can be laid out for exactly how they're going to be captured in capital requirements or leverage requirements. But in a way, and this goes to the sort of look no hands theory of macroprudential policy, once you've encouraged people to measure the risks properly, you don't need to do anything else. Now, whether that will prove accurate, I don't know. But actually, it's why this first step is absolutely key to encouraging people and giving them the sort of incentives to measure the risks properly now, because it's going to start mattering, well, already that they capture these things.
COVID has been a huge shock. We know that much. We perhaps don't know exactly a huge shock to whom. So to run off some facts, which you know much better than I do, the government has borrowed more money than it has done since the world wars. The Bank of England has expanded its balance sheet hugely. At the same time, house prices have been shooting up just recently with a stamp duty holiday, which is perhaps going to be coming to an end shortly. Some warning lights on inflation, maybe. At the same time, unemployment, people have been worrying about it a lot, but there's been a lot of support. So there's a huge shock, at least to the public sector, maybe less the private sector. But how do we start to recover from COVID? What is the FPC's appropriate role in all this?
Yeah. Okay. First of all, I think is the immediate issue of how a financial regulator can help the recovery from COVID. And I think actually the biggest issue here is the indebtedness of the private sector coming out of this. So it was absolutely essential, I think, that when you shut down the economy, the state, if you like, helped companies bridge from one side of that to the other, bridge that chasm. To do that, I think, was so important because it's what stops a short-term, although pretty prolonged, shutdown of the economy from becoming a long-lasting thing with a huge legacy impact of high unemployment, mass corporate failure. So all of the fiscal schemes, furlough, grants, all of the lending schemes to help companies fill their cash flow deficits in the shutdown period, I think have been absolutely essential. And those lending schemes, effectively companies taking on more debt, were the only and the natural way to bridge a short-term cash flow issue. But they do leave a legacy. Now, I don't think they've left companies in the UK with levels of debt that they can't service. So they're not, if you like to use the jargon, zombie companies. They're companies that may now just have a bit more debt than they're comfortable running in the long run. And they may all want to do the prudent thing, which is start to retain earnings, pay down the debt. But of course, what makes prudent sense individually isn't necessarily prudent from the macro perspective. That, if done sort of en masse, is a dragging anchor on the recovery. It holds back on investment, holds back on hiring. So from a financial perspective, one of the absolutely key things is to make sure the corporate sector has as much access to equity-like finance as possible, to give it, if it wants, a way to restructure balance sheets without needing to retain earnings and hold back on investment and hiring, effectively to swap debt for equity. Now, most companies, of course, though, are not listed on the stock exchange. Tiny, tiny fraction of companies listed on the stock exchange. So this is about making sure there's as much access for unlisted companies, the vast majority of companies, to access equity investment. But when you look at the balance sheets of insurance companies, pension funds, and investment funds, they don't hold much of that. Pension funds are a particularly interesting case. What should be the most patient long-term form of capital actually seems to have a fetish for liquidity. And equity that isn't listed is not a liquid asset. So we got to look at, and we are now with the government and the FCA, at what are the obstacles out there, whether they're regulatory, conventions, accidents, that are stopping long-term capital being deployed into unlisted equity for many, many companies. This has been a long-standing problem in the UK. It's a sort of chronic problem, but now it's an acute problem given the recovery from COVID. So that's, I think, the key area for the FPC to focus in terms of supporting the recovery. But the other area is to look back on what happened and ask, what did it tell us about the stability, the true stability of the system? Now, I think it told us some really positive things, like banks are very resilient. If we'd had the banking system of 2008, back in March last year, we'd have had a public health crisis and a banking crisis. Not a great result. We didn't have that. So that's a good news story. But there are, I think, three issues that policymakers need to look at. The first is, we built resilience into the banks in particular, but are they able to deploy that resilience when it's needed? So they have big capital buffers. They can absorb losses and keep lending. Question, though, is, are they really willing to run down their capital buffers? Are they as serene as their regulators are about that? Because that's essential for turning bank resilience into resilience that matters for the economy, which is credit being available whenever you need it. And that needs, I think, another look. That's a big lesson of this crisis, that banks weren't quite as willing as we hoped to take the losses and dip into their capital buffers while carrying on lending. The second area comes out of what happened in sovereign bond markets last March, where the behavior of lots of non-bank institutions, hedge funds, investment funds, money market funds, you name it, it added up to a hiatus in very important sovereign bond markets that couldn't be tolerated. Monetary policy authorities had to step in with drastic action and do something about it. So that it was solved, but actually at what cost? We used up monetary policy space. We created perhaps some perverse incentives for players in the market to think, oh, don't worry, if this happens again, they'll buy lots of sovereign bonds. And we had to stop yields rising and financial conditions tightening. But that's not an ideal situation. So that needs to be addressed. And actually, that's one of the issues that needs a global solution, because lots of the markets might be here, but the players in them are located all around the globe. And we need to make sure that those players aren't under, if you like, stress in conditions like that mean they're scrabbling around for cash. And that's why the reform agenda that the FPC has contributed to, but the FSB, the G20 authority, is leading, I think is so vital, because it's an area that was exposed that frankly isn't satisfactory when it comes to financial stability. But then the third question, and it goes to your point about government debt, is actually we need, in the light of this, I think, to look at what's the playbook for dealing with a recession in general. What role does monetary policy play? What role does fiscal policy play? Because we're in an environment now where short-term interest rates are very low, long-term interest rates are very low already. The scope for monetary policy to really provide much more stimulus in another downturn is more, it's not zero, but it's certainly more limited than it used to be. And we've also learned in this episode that fiscal policy can be pretty nimble and pretty effective. So what does that tell us as policymakers about the sort of standard textbook approach that fiscal policy is very stable and monetary policy is there to manage demand through the cycle? I think it tells us that we might need to revisit that. There's probably a need for a new recession policy playbook to be developed. And that's not something any individual authority is going to develop. It's probably not something any individual country is going to develop either. That's going to take serious thought from lots of people around the world to try and put that together. And it goes to this mentality that financial regulators have. Don't try and forecast, will there be another recession soon? And then write the playbook. Just ask, could there be another recession sometime? The answer is yes, there could. I don't know when, I don't know what will trigger it. There just could. So get ready, start writing the playbook now. And that's, I think, where financial regulation has a sort of philosophy, can't even say the word, a philosophy it can apply to macro policy more generally.
So just to drill into one aspect of that, I mean, as you pointed out, part of the important policy response to COVID has had the effect of increasing the indebtedness of companies, companies perhaps less than the financial institutions. If interest rates were to start to go up, perhaps because of inflation or perhaps because of movements in the gilt market, it's the companies that sort of the non-financial institutions, but the people that they lend to, that might find that they're particularly fragile and get themselves into some difficulty really rather quickly. That could morph obviously into financial stability rather fast. Is the FPC able to look sort of through the banks to the soundness of the people that they lend to?
Yes, and this is really important, that you're not so much looking at the banks, you're looking at the people they lend to. And actually the picture, when you look at the UK's corporate sector, it's pretty good. Even though it's taken on a lot more debt, it doesn't have a large number of very highly indebted companies. It has, if you like, a cushion for interest rates to go up and debt servicing burdens still to be pretty reasonable by historical standards. And that's why I go to this point that it isn't so much about serviceability, even if interest rates were to rise, it's not so much about serviceability of debt. It's about whether companies feel maybe they want to readjust their balance sheet because maybe they want the scope to access more credit in the future if they need it. So they want to prudently adjust their balance sheet today. And it's making sure that they have as wide a range of ways of doing that as possible, so that we make sure that individually prudent behavior doesn't collectively become a sort of dragging anchor.
So that's interesting. So really what I think you're pointing out is the issue to be aware of is more the debt overhang, sort of investment of firms rather than their ability to survive after this COVID shock.
That's right, yeah. And that's why the financial stability perspective isn't so much about the lenders or indeed whether the borrowers can repay. It's actually about giving them as many opportunities as possible to deal with that overhang in a way that doesn't act as a dragging anchor on the recovery.
Alex, thank you very much. You've been a great supporter of the partnership between the Bank of England and the University of Warwick, and I certainly can say on behalf of the university and our students that we're very grateful, and I think that the Masters in Central Banking and Financial Regulation, those students will gain an awful lot from being able to listen to the insights that you've provided today. So thank you ever so much.
Thank you
for making the time.